The sequencing that Steve references, not just the proposals they're offering, but the order in which they are offered.
Yes. And so, well, this is perfect because I was just talking about this. I don't know how much had come through, but saying that they really need to do the commercial paper facility stand up exactly the kind of thing that we were doing when I was there in 2008, 2009. And they are doing that. And I think that makes sense. Exactly as you and Steve were talking about, this is a crucial market for basically short-term borrowing by companies. And if you don't get this short-term borrowing, you can't make payments out, you can't pay your employees, you can't pay your customers. And so if this freezes up, it's a real problem. And so it's very important in the financial markets, very important for many companies. And so I think it's crucial that they've stepped in. It doesn't surprise me they would do it because we've done that before. There are potential that they could do more types of lending, something that we did not do during the financial crisis in 2008, 2009, was use these emergency powers, these so-called Section 13.3 powers, to be able to do lending to a broader set of companies. But in principle, a structure could be set up where the Treasury would provide some support, like they did for this commercial paper facility, and then through perhaps a small business administration or through another institution, get money out to small and medium-sized businesses that might be finding it difficult to access that credit. There'd be a parallel to what they're doing now for the commercial paper market, which tends to be medium to large-sized business. In principle, they could do it for small and medium-sized business.
Randy, when people ask you if the Fed has learned lessons from 08 or 9 and the degree to which they are implementing those hard-earned lessons now, what do you say?
I think they're doing their best. I mean, I think they tried to be proactive and reduced interest rates and an intermeeting meeting or between the regular meeting, and then they reduced rates down to zero, or effectively to zero, before the actual meeting itself, providing $1.5 trillion worth of liquidity into the markets over a longer term than is typical. So rather than just overnight or 1 week, for longer, which is exactly what we did during the financial crisis, to extend the maturity, because people are worried about institutions existing not just tomorrow, but a few months hence. Reviving the international provision of dollar liquidity through central banks around the world. And so I think they're taking the lessons out of the playbook. I think they've learned a number of things to be able to do these quickly, proactively. And then my guess is we'll see some new things, perhaps along the lines of what I was describing.
Randy, obviously,
Hey, Randy.
So the Fed has invoked the financial crisis playbook, utilized some of the same tools, and obviously is attentive to the way you can have these kind of unforeseen effects of, going after parts of the economy that aren't directly impacted by the crisis. But I'm wondering, are you personally surprised that the liquidity has essentially dried up in all these areas so quickly under stress?
Guys?
Unfortunately, I think this is, when people get scared, what do they want? They want safe, liquid assets. So they're going to run right to those. And so it's no surprise that in a highly uncertain and volatile environment, they would want that. But I do think that there have been some unintended consequences of some of the rules that have been put in post-crisis. People were trying to make the system more resilient, and so I think the motivations were very sound and very solid. But the interactions of some of the liquidity requirements, capital requirements, and some of the restrictions from the Volcker rule on making markets have made this a little bit more fragile than a little bit more deep. I think we'll be able to draw some lessons on reforming some of those regulations down the line. Right now, that's something we'll worry about later. Right now, we've got to get the liquidity into the markets, and the Fed is doing its darndest.
Well, they got to pair this with something else. This is just a place to bring your good paper.
Yes, and you have to have the paper. That's right, and so that's why this is what the Fed can do is necessary but not sufficient, as a number of you have said before. In 2008, 2009. There was a scramble for dollar liquidity. The main problems were in the financial markets and the financial institutions themselves. Here, and there, the Fed had the tools to directly address that. Here, it's related to the virus. So it's related to broken supply chains. It's related to restrictions that make people unable to either get out to buy things or to get out to work. There's no Fed policy that can possibly directly address that. And so that's where the health authorities and fiscal authorities have to come in.
Although, Randy, I have to imagine that somewhere deep within the closets of the Fed, there was a playbook that asked the question, what would happen if a global biological event took place? And that book is clearly being opened. I mean, I would assume there is some level of emergency planning that is now relevant and being enacted because of this.
Oh, of course. But as I said, with something like this, the shock is coming from outside the financial system, the Fed can't directly solve it. They can directly solve liquidity problems, and they're trying to do that. And in 2008, 2009, that was a large source of the problem. Here, the source of the problem is something that is far outside of what the Fed can directly do. And so they can provide a foundation for recovery, to try to find a foundation for preventing things from going too far south. But it's the health authorities and fiscal authorities that have to act. On top of that, the Fed can't cure the virus. The Fed can't repair broken supply chains.